Most people imagine that losing millions in investing requires a dramatic mistake. They picture risky speculation, huge market crashes, or reckless decisions. In reality, the mistake that costs many people the most money is often very small and almost invisible. It happens quietly, repeated over years, slowly reducing the potential growth of their investments until the final difference becomes enormous. This mistake usually begins with delay. People plan to invest someday, but not today. They wait for a higher income, a better moment in the market, or more financial certainty. Days become months, months become years. During that time, money that could have been growing remains idle. The power of compounding depends heavily on time. When money is invested early, even modest returns can multiply dramatically over decades. But when someone waits too long to begin, the compounding process has fewer years to work. At first, the delay does not seem important. Missing a few months or even a year of investing feels harmless. However, when delays continue repeatedly, the long-term impact becomes much larger. Another form of this mistake appears when investors withdraw money too early. Short-term needs or emotional reactions sometimes lead people to sell investments before they have fully matured. Impatience also contributes to this costly error. Many investors expect rapid growth and become disappointed when progress feels slow. When results do not appear quickly, they abandon their strategy. Frequent trading is another variation of the same mistake. Some investors constantly buy and sell assets in search of perfect timing. While this activity feels productive, it often interrupts the natural growth of investments. Small fees and costs also represent a hidden version of this mistake. Many investors ignore management fees, transaction costs, or expensive financial products. Emotional reactions can amplify the problem. Fear during market declines pushes people to sell, locking in losses and preventing recovery. Ultimately, the small mistake that costs millions is rarely a single dramatic action. It is the quiet combination of delay, impatience, unnecessary costs, and emotional decisions repeated over many years. Another version of this costly mistake is underestimating the power of small contributions. Many people believe investing only matters when large amounts of money are available. Because of this belief, they ignore opportunities to invest smaller sums. Over time, these missed contributions represent thousands of dollars that could have been compounding and growing steadily. Some investors also fall into the trap of waiting for the perfect market moment. They watch prices carefully, hoping to buy at the lowest possible level. Unfortunately, perfect timing rarely exists. While they wait for ideal conditions, years of potential growth quietly disappear. Another costly mistake is abandoning a long-term strategy during periods of market volatility. When prices fall, fear increases and confidence disappears. Instead of staying invested, some people exit the market completely. Unfortunately, recoveries often happen faster than expected, leaving them behind. Many investors also underestimate the importance of patience. Early investment growth can feel slow and unimpressive. Because progress appears small at first, people may assume their strategy is ineffective. However, compounding often accelerates only after many years. Another small but expensive mistake is ignoring diversification. Concentrating investments in a single asset may feel exciting when that investment performs well. However, unexpected events can quickly damage a concentrated portfolio. Some people also make the mistake of constantly changing their strategy. Each time they hear a new opinion or prediction, they adjust their investments. This frequent shifting prevents any strategy from working properly over the long term. Another overlooked issue is inflation. Money that remains idle slowly loses purchasing power over time. Even small inflation rates gradually reduce the value of savings that are not invested. Many individuals also forget the importance of discipline during strong markets. When prices rise quickly, confidence increases and risk-taking becomes more tempting. Some investors abandon their careful strategy in search of larger gains. Another costly habit is ignoring long-term planning. Without clear financial goals, investments can become random decisions rather than part of a structured plan. Over time, these small mistakes accumulate. Each delay, emotional reaction, or missed opportunity quietly reduces the potential growth of a portfolio. What appears insignificant today can become extremely expensive decades later. Another small mistake that becomes extremely expensive is stopping investments. During difficult times, when markets decline, fear often convinces people to pause their contributions. They believe waiting for stability will protect their money. However, These moments often present the best opportunities to buy valuable assets at lower prices. Missing these periods removes an important advantage from long-term investors. Some investors also underestimate the cost of impatience. They begin with a long-term plan but abandon it after only a few years because the results appear modest. Wealth building often feels slow in the beginning. Those who quit too early lose the chance to experience the powerful acceleration that compounding can create after many years. Another hidden mistake is spending money that could have been invested. Small lifestyle choices repeated daily may appear harmless, yet over decades, those same amounts could have grown significantly if invested instead. The opportunity cost of everyday spending is often far larger than people realize. Many individuals also overlook the importance of reinvesting profits. When investments generate returns, some people withdraw the gains instead of allowing them to continue compounding. While taking profits may feel rewarding, it interrupts the growth process that could have multiplied those returns in the future. Another subtle mistake involves chasing performance. When an investment performs well, many people rush to buy it after the price has already increased significantly. Meanwhile, they may sell assets that temporarily underperform. This behavior often results in buying high and selling low, the opposite of a successful long-term strategy. Some investors also fail to review their financial progress regularly. Without occasional reflection, it becomes easy to drift away from long-term goals. A simple habit of reviewing investments and financial priorities helps maintain focus and correct small mistakes before they grow larger. Another mistake is assuming that investing success depends entirely on finding the perfect opportunity. In reality, consistent participation in the market often produces better results than constantly searching for rare breakthroughs. Small, repeated investments can outperform sporadic large decisions. Many people also forget that time is the most valuable asset in investing. When they delay action, they are not just postponing investment, they are reducing the number of years available for compounding. Even a few lost years can dramatically reduce potential wealth. Another costly habit is allowing emotions to control financial decisions. Fear, excitement, and impatience can push investors to act at the wrong moments. Learning to remain calm and follow a disciplined plan protects long-term growth from these emotional reactions. Over decades, the difference between disciplined investors and those who repeat small mistakes becomes dramatic. The disciplined approach may appear slow and uneventful at first, but over time, consistency transforms small investments into substantial financial strength. Another small investing mistake that becomes extremely expensive is ignoring regular contributions. Some people invest once or twice and then stop, believing their initial effort is enough. However, investing works best when it becomes a continuous habit. Regular contributions allow investors to benefit from different market conditions and steadily expand their portfolio. Without this consistency, the growth process becomes weak and unstable over time. Many investors also underestimate the danger of emotional decisions during strong market rallies. When prices rise quickly, excitement can replace discipline. Some people begin taking unnecessary risks or investing more money than they originally planned. If the market later declines, those impulsive choices can lead to large losses and regret. Another mistake involves ignoring long-term planning. Without a clear strategy, investment decisions become random and reactive. A strong plan defines goals, time horizons, and risk tolerance. When investors follow a structured plan, they are far less likely to make costly decisions based on temporary market movements or short-term emotions. Some individuals also underestimate the importance of diversification. Placing too much money in one company, sector, or asset class may create the illusion of higher potential returns. However, unexpected events can quickly damage a concentrated portfolio. Diversification spreads risk and helps maintain stability over time. Another costly habit is constantly comparing investment results with others. Financial journeys are unique, yet many investors become discouraged when they believe others are achieving faster results. This comparison may push them toward riskier strategies in an attempt to catch up, often increasing the chance of losses. Many people also ignore the impact of inflation on idle money. Cash that sits unused slowly loses purchasing power each year. Even small inflation rates can significantly reduce the real value of savings over long periods. Investing allows money the opportunity to grow faster than inflation. Another subtle mistake is abandoning investments during periods of uncertainty. Economic news, Political changes or global events can create anxiety. Some investors react by withdrawing their money entirely. Unfortunately, the market often recovers unexpectedly, leaving them without the growth they could have experienced. Some investors also believe that financial success requires complicated strategies. In reality, many of the most successful portfolios rely on simple principles such as diversification, patience, and regular investing. Complexity often increases mistakes rather than improving results. Another hidden cost appears when investors fail to remain patient. During the early stages of investing, initial growth may appear slow and unimpressive. However, those early years are quietly building the base that future compounding will expand. Over time, the accumulation of small mistakes can create a massive financial difference. The investor who stays consistent, patient, and disciplined allows time and compounding to do the heavy work. Those who repeat small errors may never realize how much potential wealth quietly disappeared. Another small mistake that can cost investors millions is ignoring the importance of long-term commitment. Some people begin investing with enthusiasm, but gradually lose focus as life becomes busy or priorities change. When contributions stop and attention shifts elsewhere, the momentum of financial growth weakens. Long-term wealth often belongs to those who remain committed, even when investing no longer feels exciting. Many investors also underestimate how powerful consistency can be. They believe success depends on finding a perfect opportunity or making one brilliant decision. In reality, steady actions repeated over many years usually create stronger results. Small investments made regularly allow compounding to build momentum and gradually transform modest savings into significant wealth. Another hidden mistake is ignoring financial education. Some individuals invest without understanding the basic principles of markets, risk, and diversification. Without this knowledge, they may follow trends, rumors, or emotional impulses. Learning even simple financial concepts can dramatically improve decision-making and protect investors from costly errors. Some investors also make the mistake of focusing only on short-term performance. When results fluctuate over weeks or months, they become discouraged and begin questioning their strategy. However, successful investing requires a much longer perspective. Short-term changes rarely define long-term outcomes. Another subtle mistake is failing to adapt gradually as circumstances change. Life events, career progress, and personal goals may evolve over time. Investors who periodically review and adjust their plans maintain alignment with their long-term objectives while still preserving their disciplined strategy. Many people also ignore the psychological side of investing. Fear and excitement can influence decisions more strongly than logic. Learning to recognize these emotions and remain calm during market changes protects long-term investments from impulsive actions that could interrupt growth. Another costly habit is believing that investing success must be dramatic. Some expect constant excitement or large gains in short periods. In reality, wealth is often built through quiet, steady growth that becomes noticeable only after many years of patience and discipline. In the end, the small investing mistake that costs millions is rarely obvious at the beginning. It appears through delays, impatience, emotional decisions, and missed opportunities. Those who avoid these small errors and remain consistent give their investments the time and stability needed to grow into lasting wealth.